Welcome to today's breakdown. Right now, there's an everyday millionaire somewhere in America, a person who spent years building wealth through steady paychecks and faithfully contributing to traditional retirement accounts. Yet their $500,000 nest egg is quietly heading toward a tax problem they never properly calculated. A simple 4% withdrawal rate paired with Social Security income can push earnings high enough that as much as 85% of those Social Security benefits become taxable. Meanwhile, another retiree living a few houses away with only half that balance could end up retiring with more flexibility, more longevity, and more spending power. Not because fortune favored them, but because they understood the difference between money saved and money actually kept. And here's the uncomfortable part most people never hear. The four mechanisms we're about to cover are almost completely absent from the standard retirement calculators people rely on every day. Those systems were designed around account balances, not around account structure. And that distinction matters far more than most people realize. When someone sits down with a financial planner for the first time, they usually ask the same familiar question: have I saved enough for retirement? But that's not the question that truly determines the outcome. The better question is this: will my income survive as long as I do? Those are two entirely different problems with two very different answers. Someone can spend 30 years responsibly asking the wrong question and still retire in worse shape than a person who asked the right one while saving much less. I've watched this happen repeatedly over the years through my own investing experience, and by spending more than a decade around accountants and tax attorneys who explained, in blunt detail, exactly what happens to money once it leaves your accounts and enters the federal system. The framework you're about to learn took me years to fully grasp, but it should only take you about 20 minutes to understand. So let's get into it. Here's what this video will show you. I'm going to demonstrate, using real numbers you can check yourself, why someone with $250,000 structured intelligently can repeatedly outperform someone retiring with $500,000 structured poorly. We'll walk through four specific mechanisms, not theory, not motivational talk. Actual financial mechanics tied directly to dollar amounts that silently eat away at retirement balances across the country every single day. And by the end, you'll have a framework that permanently changes how you view every retirement account you've ever opened. The reason retirement planning became so distorted is surprisingly simple. Society built an entire financial culture around one number alone: the account balance, the scoreboard, the number you refresh at midnight when you can't sleep. But the scoreboard doesn't reveal how much disappears to taxes, how much goes toward management fees, how much gets destroyed by bad timing, or how much evaporates during the Medicare and healthcare gap years. The scoreboard only shows the gross amount, and nobody retires on gross income. Think about your paycheck. If you earn $100,000 annually, you don't actually take home $100,000. After federal taxes, state taxes, payroll deductions, and health insurance costs, maybe you keep $65,000, maybe even less depending on where you live. The six-figure salary is the gross number. The amount left afterward is your net. That's the figure your life actually runs on. Everything else is just a headline on paper. Retirement accounts work exactly the same way. The balance you see on your statement is your gross retirement number. It's the figure people brag about online and compare over dinner conversations. But taxes, fees, healthcare costs, and market timing slowly carve away at it year after year until the money you actually spend looks nothing like the amount you originally saved. Meanwhile, the retiree with $250,000 who structured things correctly may end up converting almost every dollar into usable spending power. Their gross to net efficiency might approach 90%. So your balance is your gross retirement number. But where is your net? That question forms the backbone of this entire discussion. Every section from here forward answers it. And shortly, I'll show you the mechanism that damages retirees the most. Ironically, it has very little to do with taxes and everything to do with the sequence in which financial setbacks strike your portfolio. But first, we need to understand why large traditional retirement accounts are often more dangerous than people realize. Meet Marcus. Marcus is 52 years old. He's been remarkably disciplined for decades. He maxed out his 401k for 25 straight years and accumulated around $500,000 inside a traditional pre-tax retirement account. No Roth IRA, no taxable brokerage account, just one single bucket. And to be fair, Marcus followed the advice he was given. He was told correctly that a 401k grows tax-deferred. What nobody emphasized strongly enough is that tax-deferred does not mean tax-free. It simply means taxes arrive later, and later comes with a very specific age and a very specific mechanism that makes the situation worse than most people expect. It's called the required minimum distribution. The IRS uses required minimum distributions, or RMDs, to force withdrawals from traditional retirement accounts. If you were born between 1951 and 1959, RMDs begin at age 73. If you were born in 1960 or later, withdrawals begin at age 75. For Marcus, a $500,000 traditional account combined with the IRS lifetime divisor of 26.5 produces an initial mandatory withdrawal around $18,900 at age 73. And every dollar of that withdrawal counts as ordinary taxable income. Now here's where the gross versus net problem explodes. That mandatory income can push retirees into higher tax brackets. It can cause Social Security benefits to become taxable, and it can trigger sharply higher Medicare premiums through something called IRMAA. Even a relatively modest IRA withdrawal can start a chain reaction where more Social Security becomes taxable, so every additional dollar effectively gets taxed twice. First as regular income, and second because it drags more Social Security into the taxable category. The combined impact of RMDs plus Social Security often pushes retirees into higher federal brackets, higher state taxes, and even larger taxes on investment gains. But IRMAA is where things become painfully specific. IRMAA brackets work like cliffs, not gradual slopes. Exceed a threshold by even $1, and you trigger the higher Medicare premium across the entire amount. Not just the income above the limit. And because RMD divisors shrink every year while account balances continue compounding, retirees commonly cross the first IRMAA threshold somewhere between ages 75 and 77. Once that happens, combined Medicare, Part B and Part D surcharges can range from roughly $1,148 to nearly $6,936 annually on top of the regular monthly premium. This entire chain reaction is what planners now call the tax torpedo, and it's called a torpedo because it hits suddenly. Your lifestyle doesn't change, yet your taxes and healthcare costs spike anyway. The torpedo is not one isolated event, it's a cascade. One forced withdrawal increases taxable income. That causes Social Security taxation up to 85%. Then Medicare surcharges kick in, and together they erase a significant portion of the money Marcus spent decades building. If someone has $1 million sitting inside a traditional account, they don't truly have $1 million of usable retirement spending power. Once taxes are applied, maybe 30% disappears to federal and state obligations. That leaves closer to $700,000 in practical spending value. Now compare that with another retiree who only saved $250,000. She also invested consistently, but she diversified the structure of her accounts. She holds $100,000 inside a Roth IRA, $80,000 inside a taxable brokerage account, and $70,000 in a traditional IRA. When retirement begins, she draws from the Roth and taxable accounts first. That keeps her taxable income low enough to carefully manage her bracket, while also creating opportunities for strategic Roth conversions. Her modified adjusted gross income stays low enough that none of her Social Security becomes taxable. She pays only the standard Medicare premium with no IRMAA surcharges. And Roth withdrawals don't count toward IRMAA calculations at all. Retirees who spent years building Roth balances gain something extremely valuable: flexibility. They decide how much taxable income to create rather than allowing the IRS to dictate it through mandatory withdrawals. So while she technically retires with only $250,000 gross, her effective net spending power could approach $235,000 or more, depending on Social Security timing. Marcus, meanwhile, may only keep about 65 to 70 cents of every dollar after taxes and penalties ripple through the system. His $500,000 account may effectively function more like $325,000 in practical purchasing power. She retires wealthier despite saving half as much because her gross number and her net number remain almost identical. Your balance is your gross retirement, but where is your net? Now stay with me because the next mechanism becomes deeply counterintuitive. Most people assume the biggest threat is simply losing money during a market downturn. But the real problem is far more precise than that. And smaller, better structured portfolios often survive it much more effectively than larger portfolios do. This is called sequence of returns risk. Sequence risk is the danger that poor market returns early in retirement permanently damage how long your money lasts. And this isn't just academic theory. Research from Wade Pfau suggests roughly 77% of retirement outcomes can be explained by returns generated during only the first decade. That statistic should make people pause. Average returns alone don't tell the full story. A portfolio taking withdrawals behaves completely differently than one still growing untouched. Here's why. When markets decline and you still need cash, you're forced to sell a larger percentage of your investments to produce the same income. That drains the account faster and leaves fewer assets behind to recover when markets rebound. Now let's look at actual numbers. Imagine two retirees starting with identical $1 million portfolios. Each withdraws $40,000 annually and both ultimately average the exact same 6.5% return over 10 years. One experiences negative returns early, the other gets positive returns first. After a decade, the retiree who encountered losses first finishes with around $880,000. The retiree who received gains first ends with roughly $1,358,000. That's a $478,000 difference created entirely by timing. Same average return, same withdrawal amount, same starting balance. Sequence alone changed everything. Research also shows negative returns during the first 5 retirement years account for nearly 70% of failed retirement plans because the depletion compounds over time, even after markets recover later. And this is where the smaller balance suddenly gains an enormous structural advantage. The retiree with $250,000 spread across multiple account types, combined with Social Security income and lower required withdrawals, doesn't need to pull aggressively from investments during bad years. Maybe they only withdraw 4 or 5% annually. Meanwhile, someone relying entirely on a single traditional account could end up pulling 20% or even 25% annually just to sustain expenses. Morningstar's 2025 research showed retirees who experienced poor early market returns and failed to adjust spending were dramatically more likely to exhaust their savings. You can still earn strong average returns over decades and run out of money anyway if the losses happen early enough. And because modern retirements may last 30 or even 40 years, those early losses become magnified over time. Without a strategy protecting against downturns at the beginning, financial independence can quickly become financial fragility. The larger the single account and the heavier the withdrawal demands, the more exposed the retiree becomes to sequence risk. Meanwhile, the smaller diversified structure with multiple income sources becomes resilient almost automatically. Not because of luck, because of design. Your balance is your gross retirement. But where is your net? Now here's the part standard retirement calculators almost never show you. Recognizing that structure matters more than balance is one thing. Building an actual mathematical system around it is something else entirely. Knowing the proper order for withdrawals, the correct Roth conversion windows between ages 62 and 73, and the exact income levels needed to preserve ACA healthcare subsidies before Medicare begins requires a level of planning most people never encounter. Not because they lack discipline or intelligence, but because the information is scattered across IRS publications, actuarial data, healthcare regulations, and fee disclosures few people ever connect into one coordinated framework. That's why I created a digital book called The Exit Code. It contains 8 chapters built entirely around retirement math and historical data from the last 50 years. No motivational fluff, just practical frameworks and numbers. One section explains the dynamic withdrawal strategy, which replaces the rigid 4% rule with a system that adjusts based on market conditions. Morningstar's 2025 analysis found that while a traditional 3.9% withdrawal rate provides high confidence for fixed spending plans, retirees willing to adapt spending dynamically could safely begin closer to 5.7%. That difference can dramatically improve retirement lifestyle. Another chapter explains what I call the invisible $14,000 healthcare bill. It covers the average annual healthcare exposure for retirees leaving work at 62 before Medicare begins, and how account structure determines whether that burden feels manageable or devastating. Most financial advisors are not going to hand you a complete roadmap tying all these systems together. That's not necessarily criticism. It's simply the nature of an industry compensated based on assets under management rather than the efficiency of your final retirement outcome. The exit code costs less than a single dinner out through the link below. And every year these strategies remain unused is another year the math compounds against you. That isn't marketing pressure, it's arithmetic. Now let's discuss the part of retirement planning that honestly becomes almost funny once you fully understand it. Because at some point, the only reasonable response to normalized fee structures is to laugh at how absurd they really are. Imagine you have $500,000 invested and your advisor charges 1% annually. Most people hear that and think, okay, that's about $5,000 per year. Not ideal perhaps, but manageable. Except that's not what 1% actually costs over time. The gap between paying 0.1% and paying 1% after 10 years becomes approximately $15,800. By year 20, that difference grows to around $59,100. By year 30, it balloons to nearly $165,800. And the growth is not linear. The compounding damage accelerates dramatically during later years because the fee continuously erodes a larger and larger base. Over a 30-year period, an investor paying 1% instead of 0.1% may surrender roughly 22.4% of their potential ending wealth. At 1.5%, the loss climbs near 32.7%. On a $1 million portfolio, a 1% advisory fee can reduce wealth by almost $1.9 million over time. Nearly $2 million. Not because of market crashes. Not because of economic disaster. Simply because the fee structure collected money regardless of results. Now, to be fair, some advisors absolutely earn their fees. The ones delivering sophisticated tax planning, Roth conversion strategies, Social Security optimization, and behavioral coaching during market crashes may save clients far more than they charge. If an advisor prevents panic selling and reduces lifetime taxes by tens of thousands of dollars, the fee may be worth every penny. But if the arrangement amounts to placing your money inside a target date fund and calling once every quarter, there are low-cost index funds charging around 0.03% annually instead of 0.7% to 1%. That's roughly 30 times cheaper. The retiree with $250,000 invested in a simple, low-cost, 3-fund portfolio keeps their compounding engine almost perfectly intact. Every dollar remains invested and growing. Meanwhile, the person with $500,000 paying 1% for decades may unknowingly surrender a huge portion of retirement wealth, not because of poor luck, but because the structure itself was never designed to maximize net outcomes. Your balance is your gross retirement, but where is your net? Now we arrive at the final piece that ties everything together. This involves Social Security timing, healthcare costs, and a retirement decision window many people either completely overlook or get financially trapped inside. If you delay Social Security benefits, your payment increases every month until age 70. The increase equals roughly 2/3 of 1% monthly, or about 8% annually. Guaranteed. Backed by the federal government. In 2026, the difference between claiming at 62 and waiting until 70 can exceed $2,212 monthly for maximum earners. For perspective, the average monthly Social Security benefit in 2026 sits around $2,071. That means the increase from delaying benefits can exceed the entire average retirement check. But here's the structural issue. Someone with $500,000 entirely inside a traditional 401k only has one liquid income source. Every withdrawal creates taxable income. They often need that money immediately at age 62, forcing early Social Security claims and permanently locking in lower benefits. Meanwhile, the retiree with $250,000 spread strategically across account types can draw from Roth assets first. And because Roth withdrawals don't count toward MAGI, they preserve healthcare subsidies and delay Social Security until age 70. That effectively creates an 8% guaranteed annual increase in lifetime income simply by having the correct account structure bridging the gap years. Now let's talk about healthcare. If you retire at 62, Medicare does not begin until age 65. That leaves 3 years of private insurance exposure. ACA marketplace premiums for a 62-year-old in 2026 often range between $1,000 and $1,800 monthly. That equals roughly $12,000 to $21,600 annually per person. Over 3 years, that's $36,000 to $64,000 before Medicare even begins. Fidelity's 2025 estimate suggests the average retired 65-year-old couple may spend around $172,500 on healthcare during retirement, excluding long-term care. And here's the surprising twist. Roth withdrawals do not count toward MAGI. Traditional IRA withdrawals do. So the retiree with Roth-heavy accounts can preserve ACA subsidies and dramatically reduce insurance costs. The retiree relying entirely on traditional accounts often loses subsidies entirely because every withdrawal inflates taxable income. I know someone who retired at 63 and paid nearly $18,000 annually for health insurance simply because every dollar available to him came from pre-tax accounts. His neighbor retired the same year with similar spending needs and paid under $3,000 annually because she spent years building Roth balances specifically for this exact window. That's a $15,000 yearly difference. Over 3 years, it becomes $45,000. Almost the entire balance difference we discussed earlier disappears in one healthcare category alone. Now let's revisit Marcus. Remember him. Age 52, $500,000 entirely inside a traditional 401k. Here's how his retirement unfolds. He retires at 65 but claims Social Security at 62 because he needs immediate income. There are no alternative tax-efficient accounts available. His reduced Social Security benefit becomes permanent. He begins withdrawing from the 401k immediately. During his first retirement year, combined withdrawals and Social Security create around $58,000 of taxable income. Part of his Social Security becomes taxable. His effective tax rate exceeds expectations. He eventually learns about Roth conversion strategies online at age 69 and manages only 2 years of conversions before RMDs begin at 73 anyway. The mandatory withdrawals push him over IRMAA thresholds, and Medicare surcharges follow for the remainder of retirement. He isn't broke. He's okay by conventional standards, but after decades of disciplined saving, he only spends around 68 cents of every dollar he accumulated because the entire structure was built around one pre-tax account. Now let's compare both retirees side by side. Person A, $500,000 entirely inside a traditional 401k, retires at 62, claims Social Security early at roughly $1,800 monthly, withdraws $24,000 annually from the 401k. First-year total income equals about $45,600. After taxes, healthcare premiums, and Social Security taxation, net spendable income lands near $31,000. Gross to net efficiency, roughly 68%. Person B, $250,000 diversified across accounts. $90,000 Roth IRA, $75,000 taxable brokerage. $85,000 traditional IRA, retires at 62, withdraws $10,000 annually from Roth assets. No taxes, no MAGI impact. Healthcare costs remain heavily subsidized below $3,000 annually. Social Security delayed until 70. Year one spendable income lands near $22,000 to $23,000 with almost no tax friction, and dramatically larger future Social Security benefits locked in permanently. Gross to net efficiency, over 90%, same market, different structure, and person B ultimately produces more real retirement lifestyle per dollar saved. The scoreboard claimed $500,000 was twice as valuable as $250,000, but the net outcome revealed something entirely different. Here's a financial advisor joke that actually contains a useful lesson. Two retirees attend a planning seminar. One says, "I have $1 million inside a traditional IRA." The other replies, "Interesting. What does your accountant say it's actually worth?" That silence afterwards says everything. Americans now believe they need roughly $1.46 million to retire comfortably in 2026. Last year, the number was closer to $1.26 million. Every year, people increase the target because they keep adjusting the wrong variable. They inflate the gross number while ignoring the structure determining the net result. Even Bill Bengen, creator of the famous 4% rule, has admitted people dramatically oversimplified his research. Morningstar's 2026 findings suggest fixed withdrawal plans near 3.9% provide strong reliability, but flexible strategies can safely push spending closer to 6%. That difference represents the gap between a rigid gross framework and an adaptive net framework. The retirement industry was largely designed to maximize balances. That's how advisory businesses operate. And advisors naturally have less incentive to move money away from assets they manage, even when alternative structures might produce better outcomes for the client. That isn't evil. It's simply how incentives work. And the people who understand that early often retire wealthier, despite having smaller balances. So here are 3 takeaways specific to this discussion. First, run a Roth conversion analysis between ages 62 and 73. This is the exact window Marcus missed. During early retirement, before full Social Security and before RMDs begin, taxable income may temporarily drop. That creates the perfect opportunity to convert traditional IRA money into Roth assets at lower tax rates. Every dollar converted during this window avoids future RMDs, avoids IRMAA calculations, and avoids future Social Security taxation. But the window only lasts so long, and every year ignored becomes another year of compounding tax exposure. Second, build a 3-account structure before retirement, not afterward. Taxable brokerage. Roth ERA, traditional IRA or 401k. Withdrawal sequencing becomes one of the most powerful tax management tools retirees possess. A retiree with everything inside one account type has one lever. A retiree spread across 3 structures has multiple levers controlling taxes every single year. Third, model Social Security timing with real math rather than simplistic rules. Delaying benefits until 70 increases payments approximately 8% annually. A $1,000 increase in monthly Social Security income can function similarly to having an additional $300,000 portfolio under a 4% withdrawal framework. For many retirees, delaying benefits becomes the most reliable guaranteed return available anywhere. The only legitimate reasons not to delay are shortened life expectancy or severe cash flow limitations. And if cash flow is the issue, that problem is often solvable years earlier through proper account structuring. Slow, disciplined investing has quietly built more wealth than internet speculation ever will. And if you're still judging retirement security only by the number shown on your statement, without understanding what taxes, fees, healthcare costs, IRMAA, ACA calculations, and market timing will eventually remove from it, those systems are already running the calculations behind the scenes.